Well, a surge in gasoline prices pushed the U.S. Consumer Price Index to its biggest rise in 4 years. But despite the increase in fuel costs, there was no sign of a pickup of inflation. The Labor Department says the CPI gained 0.7% in February, and that was the largest increase since June 2009. Gas prices made up for 3/4 of that increase, but the Federal Reserve is expected to dismiss that rise as temporary when they gauge the economy's health next week. And joining me to discuss the CPI data and the U.S. economy is Deaux. He's an economist at the Street. Joe, thanks for joining us.
Thanks for having me.
Joe, let's get right into those CPI numbers. So the Fed doesn't think inflation is a concern as yet. What do you think?
Well, the Fed, Ben Bernanke continues to come out and say that inflation's about where we want it. We saw today in the core CPI, it was about 2%, which is where the Fed has consistently said this is a decent target. It's on the high end. They are saying if it hits that 2.5% target, they might want to start raising interest rates. But ultimately, it was the gas prices, like you had just said, that showed a big increase. And this was because we saw gas prices run up. We saw crude oil run up between mid-January and mid-February. These were for the late March and early April contracts. And this corresponds with the high travel in cars in the spring and summer months here in the United States.
Yet we have seen a tick up in gold today. Following that data, is the market telling us that they don't agree gold traditionally bought as a hedge against inflation?
Well, what we did see, yes, indeed, gold had run up. Gold's a tough issue to talk about. Gold's been in this wild moment, at least in the past 3 months. And wild is it's not just going up, it's stuck. And so even though we saw a slight uptick on the headline CPI, it seems like traders were kind of playing a little bit off of that. I think they're waiting to see what the Fed says next Wednesday. They've had some surprises in the last two FOMC announcements, and I think they're just waiting to see what Bernanke comes out and says on Wednesday.
The big data that had an impact on the market's consumer sentiment falling to its lowest level in 15 months. What is that telling us, and what should Washington be taking away from this?
Well, Washington will look at it the way that they look at it. But I think a lot of the analysts I've been talking to, they said, okay, this is one of many other economic indicators we're looking at to make sure that the economy is on track. I don't think too many people are outraged or too seriously worried about this. I think many people are looking to the second half of 2013 for growth from companies, capital investment. Ultimately, obviously it didn't look so great, but I'm not too sure that anybody is that worried about it, to be honest.
Well, what should we be worried about?
Well, what you should be worried about is that we're going to continue to have slow growth. At least that's what most of the analysts and economists have been telling me as well, is this is a slow climb back up. I spoke to a person yesterday, a market analyst, who said, the S&P was finally reaching its all-time highs. And I said, well, what did you think about it? He said, well, it's about time. But this is something that we've been waiting for a long time. It's always going to be a wait, it seems like.
Well, you mentioned the S&P getting to its all-time high, the Dow obviously beating it 8 times in a row. But there seems to be a major disconnect between the markets and the fundamentals of the economy. I mean, the last time the Dow hit its high in 2007, unemployment was at 4.7. Now it's at 7.8. GDP in the third quarter of 2007 was 3%. Our last quarter was 0.1% after being revised. So what is this disconnect telling us?
Well, first of all, people should never think that what's happening in the equity markets is exactly what is going on in the economy, right? So you can have a run-up in equity prices for many different reasons. A lot of people have been buying in. They've been seeing it as a time where there is a rally. They figure, well, I'm going to get out of things like gold, and I'm going to put my money into equities because right now that's where the biggest return is. There's a disconnect. Of course, there's going to be a disconnect. One day you might have a bad report and the market might still be up because of another report. Ultimately, I think that people should make sure that they look at all the indicators, not just the stock market.
Let's look at the unemployment number as an indicator. We had jobless claims coming in better than expected. 330,000 people filing for first-time unemployment benefits, as opposed to 350,000, the third week of declines. But we still have about 330,000 people going and filing for unemployment benefits. What does that tell us?
Well, it shows us that the labor market still is not strong. I mean, 7.7% unemployment rate it's not low. Even though we like to look at the latest number, 360,000 or 300, whatever it was, it was high, but it's not something that one report should tell us, oh, it's great. I mean, most of the labor market economists were saying we need to see a string of numbers like what we saw on Friday to start feeling more confident about us slowly getting down to that 6.5% range.
Okay, well, thank you for that insight, Deaux, economist at The Street.